There is a number sitting inside federal banking law right now that can change what happens to an ordinary American's checking account the moment cash crosses it. Not next year, not if Congress passes something new. Right now, today, in 2026. And the reason this matters is not because it limits how much money you are allowed to keep in the bank. It does not. The reason it matters is because millions of people have heard a simplified version of this rule, misunderstood what it actually does, and then made the one mistake that creates far more trouble than the large deposit ever would have. The number is $10,000. And before you say, "I already know about that," stay with me, because the most dangerous part of this subject is not the number itself. It is the false confidence people get from thinking they understand it, especially retirees, especially people handling cash only occasionally, especially people selling a truck, settling an estate, helping family, cleaning out a safe, or depositing money that is completely legal and completely theirs. I want to say this clearly at the beginning because too many people never hear it stated plainly. The IRS did not set a legal cap on your checking account. There is no IRS rule that says you can only keep up to $10,000 in the bank. There is no federal balance limit that forces you to stay under that number. If you have $12,000 in your checking account, $22,000, or $122,000, that by itself is not the issue. The real issue is cash transactions. Under the Bank Secrecy Act, banks and credit unions are required to file a currency transaction report when cash transactions exceed $10,000 in a single business day. That means cash deposits, cash withdrawals, cash in, or cash out. And if the institution knows that multiple cash transactions are by or on behalf of the same person on the same business day, those transactions can be added together. In other words, 4 separate cash deposits that look small by themselves can still be treated as one reportable event if together they cross the line. That one detail changes everything. Because most people have been told this subject as if it were simple. Deposit more than $10,000 and the government gets notified. That is technically part of the story, but it is not the part that hurts ordinary people. The part that hurts ordinary people is what they do after hearing that sentence. They decide that the smart move is to stay below the threshold. They break a deposit into pieces. They go on Monday, then Wednesday, then Friday. Or they use different branches. Or they deposit $9,500 because someone once told them that was the safe number. That instinct is where the danger lives. Because if you deliberately structure transactions to avoid the reporting requirement, federal law can treat that as a separate offense, even if every dollar came from a lawful source, even if taxes are fully paid, even if you were not trying to hide criminal money, and even if the cash belongs entirely to you. That is the part ordinary Americans almost never learn until after they have already made the mistake. So let's slow this down and make it practical. If you sell a used pickup truck for $14,000 in cash and deposit the full $14,000, your bank will likely file a currency transaction report. That report is not, by itself, an accusation that you committed a crime. It is a routine filing required by law. In fact, these reports are filed on a massive scale. This is one reason the fear around the report itself is often exaggerated. A large, transparent, well-documented deposit is usually not the nightmare scenario people imagine. Now compare that with the version people think is safer. You sell the same truck for the same $14,000, but instead of depositing it once, you decide to deposit $7,000 today and $7,000 next week because you do not want to trigger anything. The problem is not the money. The problem is the intent. If the pattern shows that the transactions were arranged to avoid the reporting rule, that can look like structuring. And structuring is exactly what banks are trained to watch for. That is why the rule punishes the behavior people mistakenly think is cautious. Here is another part most people do not understand. The $10,000 rule is about currency, actual cash, paper money, and coins. It is not the same thing as your paycheck being direct deposited. It is not the same thing as wiring money from one bank to another. It is not the same thing as moving money between your own accounts online. It is not triggered just because your Social Security, pension, or tax refund lands electronically in your checking account. That matters because people hear bank reporting and start imagining that every transaction is treated the same way. It is not. And that brings us to the second report, the one that deserves more respect than the first. A currency transaction report is threshold-based. Cross the cash threshold, and the bank files it. A suspicious activity report is different. That one is based on suspicion. For banks, suspicious transactions that aggregate to at least $5,000 can trigger a filing when the institution suspects the activity may involve illegal funds, is designed to evade Bank Secrecy Act rules, has no apparent lawful purpose, or otherwise looks inconsistent with what the bank knows about the customer. That means you can stay under $10,000 and still create a report if the pattern itself looks wrong. That is why just stay under $10,000 is some of the worst financial advice in America, because it confuses the threshold report with the suspicion report. And when you act like someone trying not to be reported, you may end up looking more suspicious than the person who simply deposited the money honestly and all at once. Now, I want to make this especially real for older Americans, because this is where the emotional mismatch happens. A retired person is often not dealing with daily business cash. They are dealing with irregular, life event money, proceeds from selling a car, a small inheritance, cash saved at home for decades, payments from an estate sale, help from family members, a land sale, a settlement. These do not feel like criminal scenarios because they are not criminal scenarios. But the banking system does not evaluate your intentions the way your friends and neighbors do. It evaluates patterns, documentation, and risk, and patterns can be unforgiving. Imagine a widow who finds $18,000 in cash that she and her late husband kept at home over many years because they came from a generation that trusted envelopes more than apps. She wants it in the bank now. She has heard that deposits over $10,000 raise flags, so she deposits $9,000 one week and $9,000 the next. From a human perspective, that may sound harmless. From a compliance perspective, it can sound like someone intentionally arranged deposits to avoid reporting. That is the tragedy in this subject. Innocent motives do not automatically protect you from suspicious-looking behavior. And there is one more layer that makes this more important in 2026 than it felt a few years ago. Treasury has been moving federal payments away from paper checks and toward electronic delivery, with exceptions for people who do not have practical access to banking or electronic payment systems. That means for many retirees, the checking account is even more central now than it used to be. Refunds, benefits, distributions, bill payments, transfers, everything is concentrated in one place. Not because there is some new hidden IRS balance cap, but because the bank account has become the center of ordinary financial life. So if that account becomes the place where unusual cash activity shows up, you want that activity to make immediate sense. Let me give you the most important mental shift in this entire video. The report is not the enemy. The mismatch is the enemy. A large, legitimate cash deposit with a clear explanation is one thing. A series of carefully sized deposits that appear designed to avoid a report is another thing. A transaction that fits your normal history is one thing. A sudden pattern that makes no sense unless someone is trying not to be noticed is another. And when people confuse those two categories, they turn a routine compliance issue into something much more serious than it ever needed to be. Now let's talk about what banks actually see. They do not just see the amount. They see the timing. They see whether the transactions happened on the same day. They see whether they happened at different branches. They see whose account received the money. They see whether it was cash or electronic. They see whether the account is joint. They see whether the activity matches the profile they have on the customer. And if the deposit goes into a joint account, multiple account holders may be associated with that report because all of them potentially have access to the funds. So when people believe they can outsmart the system by making transactions smaller, what they are really doing is creating a pattern the system is specifically designed to notice. And this is where I want to correct another popular misunderstanding. A currency transaction report is not a tax bill. It is not an automatic audit. It is not proof you did anything wrong. The Government Accountability Office recently noted how enormous the volume of these reports has become, and how small a share are ever actually accessed by law enforcement. That should tell you two things at the same time. First, the report itself is routine. Second, the best way to stay routine is to behave routinely, not evasively. In other words, transparent beats clever. So what should you actually do if you have a large amount of legal cash to deposit? First, deposit legitimate cash in the amount you actually have. Do not split it up simply to stay under a number. If you have $12,400, deposit $12,400. If you have $24,000, deposit $24,000. Let the bank do what the bank is required to do. The worst move is trying to redesign the transaction around the reporting line. Second, keep documentation before you ever walk into the bank. If the money came from selling a vehicle, keep the bill of sale. If it came from an estate, keep the paperwork. If it came from a property transaction, keep the closing documents. If it came from cash you withdrew from another institution earlier, keep the withdrawal records. The law does not require you to panic. It requires you to be able to explain your money if someone later asks. Third, if the situation is unusual, speak to your bank before the deposit if possible. Not because you need permission, but because context matters. I sold farm equipment and will be depositing the cash this week. I am consolidating old cash savings into the account. I'm handling estate proceeds. That simple conversation can do more to make the pattern understandable than people realize. Fourth, make sure your tax reporting tells the same story your bank activity tells. This does not mean every large deposit is taxable income. It is not. Some deposits are transfers, some are asset sales, some are inheritance related, some are reimbursements. But if a transaction does have tax consequences, report it correctly. Trouble grows when the bank record tells one story and the tax return tells another. Fifth, stop taking banking advice from rumor, TikTok, comment sections, and the friend of a friend who says, just keep it under 10 grand. That advice has probably caused more self-inflicted problems than the reporting rule itself. A person who deposits the full amount of legal cash may generate a routine report. A person who choreographs deposits around the threshold may create suspicion that did not need to exist. And sixth, if you are retired and rarely deal with cash, treat unusual cash events as professional moments, not ordinary errands. A large cash deposit is not the same as buying groceries or paying a utility bill. It is one of those moments when 5 minutes of planning can save you from months of stress. If you are unsure how the source should be documented or whether it carries tax consequences, speak with a qualified tax professional before the deposit, not after the letter arrives. Now, I want to address the fear directly because I know what some people listening are thinking. If I deposit over $10,000, am I asking for trouble? Not if the money is legitimate, the transaction is honest, and the story is documentable. The better question is this: if I change my behavior specifically to avoid the report, am I creating trouble? That answer can be yes, and that is the reversal most people never hear. The large deposit feels dangerous, so they avoid it. The smaller deposits feel safer, so they choose them. But when the smaller deposits are intentionally arranged around the threshold, the legal risk can become worse, not better. That is why understanding this subject matters so much more than simply memorizing the number. The number alone does not protect you. Understanding what the number means protects you. It means the threshold is about reportable cash transactions, not your account balance. It means multiple same-day cash transactions can be aggregated. It means joint accounts can draw multiple names into the record. It means suspicious patterns matter as much as raw amounts, and sometimes more. It means structuring can be a problem even when the money itself is clean. And it means transparency is safer than improvisation. If you remember only one sentence from this video, make it this one. Never redesign a legitimate cash deposit for the purpose of staying below the reporting threshold. That sentence alone can save someone from a profoundly expensive mistake. Because ordinary Americans do not get into trouble here by being master criminals. They get into trouble by hearing half the rule, misunderstanding the half they heard, and then taking action based on bad advice. They think they are staying invisible. What they are really doing is imitating the exact behavior the system was built to detect. And I think that is why this topic feels so unfair to so many people. The rule was built for anti-money laundering enforcement. The language around it sounds like it belongs to criminals, shell companies, and organized fraud. But the people most likely to be confused by it are often older Americans living normal lives, handling one unusual cash event at a time, trying to be careful and accidentally becoming less careful than if they had simply acted openly. So no, there is no IRS checking account limit in the way people say it online. But yes, there is a very real federal reporting threshold tied to cash activity. And yes, if you misunderstand it, you can create consequences for yourself that are far more serious than the original deposit. That is the truth about the so-called $10,000 checking account rule in 2026. It is not a cap on what you can own. It is not a ban on having money in the bank. It is not a reason to fear legitimate deposits. It is a reporting system. And like most reporting systems, it becomes dangerous mainly when people respond to it the wrong way. Deposit legal cash honestly. Keep records. Report taxes correctly when taxes apply. Give unusual transactions a paper trail. And never mistake under the threshold for safe. Subscribe to Real Value Tax for weekly updates on IRS rules, banking regulations, and financial protection strategies for American seniors. If this video clarified something you had heard the wrong way for years, hit the like button and share it with someone who still thinks the safest deposit is the one that stays under $10,000. And tell me in the comments, before watching this, did you think the rule was about your account balance or about cash transactions? Stay informed, stay protected, and I will see you in the next one.